Hi friends, welcome to Dhiksoochi. Today we are going to learn asset allocation with Dr. Sabitha Godasu. After my video on 4 Ws and 1 H about investments, few of my subscribers requested to detail about asset allocation. So because of which today we are going to learn this. Before starting, I would like to thank all my subscribers and I would like to share something with you that the day one when I started my YouTube channel, I got 2-digit subscribers within an hour. Also, on the same day, I have 3-digit number viewers for the same. So I'm very happy for that, and I also thank all my subscribers and viewers of my videos. And hope you are clear with these content whatever I am posting on. If at all you require anything, any additional information, please post it to me. And let me take you to the further discussion on asset allocation. Okay, so let us start this with the definition. So what is definition? The name itself says allocating the assets, means how the fund is going to be allocated, right? Okay, so as per the definition, generally what do you say? It is the process of deciding how to distribute an investor's wealth, right? It's not an individual investor, it may be company's wealth also, sometimes you can consider. So we are distributing that investor's wealth among different investment alternatives. So I hope you remember, which was discussed in the previous slide, what are the investment alternatives are. And in continuing with the definition, so it is among different alternatives and asset classes for investment purpose. Yeah, asset classes is a new word for this video, right? So let us see what is asset class is. So asset class is, it's a comprised of securities that have similar characteristics, similar attributes, and also holding almost equal risk and return relationship, right? See, for example, if you are investing in a share market, so within the share there is a separate asset allocation. So within the share market, which industry you are looking into? If you are investing in a mutual fund, what kind of mutual fund you are investing into? So such we call it as an asset allocation. Whereas the shares and mutual funds are the investment alternatives. So I hope I'm clear for this, right? So which investment alternatives we are choosing? Within that investment alternatives, what kind of asset class you are looking into, so that you are going to distribute your wealth. You are going to distribute investors' wealth or company's wealth. Right? Yeah. Let us see the what exactly the input to the policy statement. What do you mean by policy statement? Means on which you are working on. The investment process on which we are working on. So what exactly you have to know before distributing the investor's wealth? First of all, what the investment objectives of that particular investor is, right? So as we discussed earlier also, there are several objectives, right? Out of which majorly these are the 3 generally we consider. What are those? Capital appreciation, that is, today if you invest 1000 rupees, you are expecting the same asset value after a certain period is 1100 rupees, right? So that additional 100 rupees is your capital appreciation. Then the next one is the current income and current return. So they are focused more on the present return what they are expecting on a particular kind of an investment. So how much return it is generating, how much income it is creating is also another objective of the investors. And the third one is combining all these two. Combining these two. What are those? Capital appreciation, also the return on that particular capital. So that put together we can generally name it as total return. Okay. Now let us see, there are certain constraints also. What are those constraints? We should understand the investor's point of view. What are their exclusive constraints before suggesting any investment alternatives, before selecting any asset. for the allocation of the wealth, right? So first one is liquidity needs, means when the investor is expecting the amount back along maybe capital appreciation or maybe return or total put together. So when he wants to get it, means how quickly he wants that money. Is it for, whenever he wants to take it, or he want to go for a lock-in period of 1 year or 2 year? 1 year or 2 year lock-in period, in the sense whatever the time period mentioned, till then the amount cannot be withdrawn. So you should understand the liquidity needs of the investor, right? Then time horizon, how long they wanted to invest. Though they have liquidity requirements, also they may have time horizon. In the sense, they wanted to invest for a longer period or shorter period, maybe 1 year, 5 years, 10 years. It depends on the objective of the investor. It depends on the expectation, or it depends on the need of the investor. The time horizon also have to be decided by the investor itself. Clear? Then the tax concerns. Tax concerns means, is the investment is for the sake of protecting the tax, saving the tax payment, or because no, he is within the non-taxable bracket and he want to enjoy the additional worth of 2 lakhs or 1 lakh, they wanted to enjoy that. So that also have to be considered. And if at all there are any legal or regulatory factors, from the investor's point of view also has to be known by us. Then you must stress upon the unique needs and preferences of the investor. Otherwise, wherever you are keeping the fund, because all the investments are subject to market risk, almost 50% of the market is at risk, right? So you must understand the unique needs and preferences of the investor. Then you can suggest a better asset allocation to the investor. Before you are suggesting a thorough asset allocation, you should understand. If you are doing all these for your sake, so definitely you need to understand what is your liquidity need, what is your time horizon, what are your concerns, what are the other factors affecting, and whether you are expecting appreciation or capital appreciation, or you are expecting any return on that. So everything you have to design on your own. So that is what the first input for the further process. Okay. Now, how this life cycle investment goes on, depending on the goals. Because most of the investors, they expect that in near term they have high priority goals. Sometimes not near time. Some people it is a long term high priority goals. For few people it will be lower priority goals. So if you are an individual, you should understand what is your priority goal is. How long you are going to attain that your goal. Is a near term, that is within 1 or 2 years, or long term after 3 years or 4 years or whatever it is. Or is it a lower priority goal? Depending on which you can decide how you are going to invest in it. So this preliminaries also were discussed in the previous videos, right? So once you start earning, first you have to invest in your insurance policy. We have to invest on our insurance policy. Then have little cash reserves with you so that it can meet your emergency needs. So these are the basic, the preliminaries. Then let us see how it is go on. This is a graphical representation of rise and fall of personal net worth over a lifetime. So if you see an x-axis, that is, let me take the cursor over here. Yeah. If you take the x-axis, this is talking about the age, right? See, if you are 25 years age, then 35 years age, later 45, 55, like this. The age is on x-axis. When come for the y-axis, this is net worth. Okay, net worth. So at the shortest age, means like when you are smaller, like when you are young, only of 25 age, definitely your earnings will be little lesser and net worth will be really little lesser, because just then we are starting it. So let us assume this is a time horizon between 25 and 35, right? So let us take this period. Slowly your earnings, net worth is started growing from 25 to 35, because just then you started your earnings and you slowly getting your first and second increments. So during that period, that phase is called accumulation phase, because we are accumulating your funds into several asset allocations. So definitely this accumulation for the sake of long term and short term. So when come for the long term, obviously it is a retirement and children's college need or marriage need or whatever it is. When come for the short term, yes, once you start earning, everybody's dream is to construct their own house. They want to live in their own house. They want to buy a own house, right? Also, little luxurious, they also want a car. So these are the short term goals. So when you are going to try to accommodate all these in the accumulation phase itself. Now, from accumulations phase 2, you are transforming to consolidation phase. What do you mean by consolidation phase? Means you started slowly earning or increasing your income, started getting promotions, and you are trying to get high positions in your respective jobs till the age of 658 to 62, we can assume, right? It is nearby your retirement age. So this consolidating your assets. How you are consolidating? Whatever the long term investments you have started at the early age are going to be continued and nearing to your maturity, right? Then short term, almost your basic short term needs were satisfied, that is house and car. Now you are trying to spend little more on vacations, little more on other college needs of the children, right? So this is what the consolidating means. Whatever the accumulating, that we are going to consolidate. You are going to finalize what your final investments are and how much you are going to expect at the end of your earning stage, right? Now we are coming for the spending phase and gifting phase. Why we call this phase as that is, after 55 or 58 or 62, you will get retirement. Even it is a private company, definitely, you may not work effectively, and you wanted to take rest, or you take voluntary retirement, or whatever it is. During this period, there are no earnings. Moreover, the earnings are coming down. Why the earnings are coming down? How you can expect this phase? Because as a long term planning, already you have earned lot of money. Now you are going to plan for your estate. Estate is not a big house. Already you have constructed your house and you want to modify it, or you want to construct above that, or something like that. You wanted to plan for it, and the lifetime needs are going to be increased and have to be met with your long term investments during this consolidation phase and also during the accumulation phase. During this period, you started gifting your children, gifting your friends. But what is happening? Income has come down, but your expenditure has been increased. That's what we say, that even though you are earning, definitely it is lesser than your consolidation phase. So this is how your income, net worth, as age increases, your net worth grows till certain point of time, and again it starts declining because of your additional expenditure after a certain period of time, right? All were covered during the first two phases, because you are able to earn and you are able to spend. This is how the personal net worth of every individual life, right? I hope I am clear. Now, what exactly the portfolio management process is? Once you have allocated your funds or you are starting your process of allocation of funds, then what are the steps to be considered? Right? So that is what how you are going to manage your investment, manage your wealth. First is strategic planning process output, that we call it as a strategic plan. What is strategic plan? There are so many steps involved in it. First, what are your goals? What are the definition of those goals? And what are the categories? Categories means like personal, children, luxurious, something like that. You are dividing into categories. Now, the key performance criterias. What are the key performance criterias in the sense from where you are going to get the funds and with what kind of assets you wanted to select it. And what is a capacity definition? Capacity definition is how much you want to invest and how long you want to invest. Right? How much and how long. What is your capacity? That has to be identified. This is what the basic strategic planning is. Then you slowly moving into aligning process. So we are assigning, right? Aligning. From aligning, the asset is allocated, then you are going to have monitoring on that and you are going to have control over it. So these two phases, during these two processes and phases, there are certain things, there are certain steps to be followed. What are those? First, you need to identify your asset, right, along with your goal, which suits to your goal based on the key performance criteria, based on your capacity. You need to identify the assets, right? Once you identify the assets, then you are categorizing them based on the risk and return, based on the term, during the term how much tenure you are going to invest, right, during the return especially you are talked about, and term, and depending on the objective, right. So you are categorizing them. Once you have categorized, you are going to evaluate those individual projects. Then out of whichever is meeting your strategic objectives, whichever are meeting your requirements for a future, you are going to select them. Once it's selected, you may be selected 1, 2 or 3 or 4. If you selected 1, there is no problem. If at all you have selected 2, 3 or 4 or more than 4, then you have to prioritize them. Which asset has to be taken care first, which asset to be invested first, in which asset to be invested first, right? Then once you start investing in project 1, asset 1, then afterwards you have started investing in project 3 and then project 3 or asset 3. Then what you have to do? You have to call this as now we are going to call this as a portfolio. Now balancing this portfolio is also part of your portfolio management process. If at all you are taking care of others' fund, then the same steps have to be followed. Then authorization. What do you mean by authorization? How good it is eligible and to be continued for you, and how long you are expecting the same kind or more than those returns are. So you yourself have to authorize the particular portfolio, saying that the portfolio is working well. How do you authorize? On what basis you are going to authorize means, first it is portfolio reporting periodic reviews, right? Every month or every week or every year, depending on the investment process, investment method, depending on the asset, you are going to review them. So if you are satisfied that, then fine. If you don't satisfy, then you have to change your strategy. How do you change the strategy? Again, you go back to your first strategic plan and review them, and if there are any modifications, you are going to do it. After modifications, again you are going to start from the step 1. right? In between, sometimes, okay? So sometimes after this seventh, either you can directly go to portfolio periodic reporting and review, or else sometimes you also have to component execution and reporting, in the sense, if at all you find anything is additional and added to your selected investment alternatives, asset allocation, then again you need to do the periodic review. Then it is forward to the strategic change. So finally what we have to say, first is have a strategic planning, right? What is your goal, what is your term and everything. Then you select and invest. Third one is review, if required modify. This is how our portfolio management process should be taken care in 3 different steps. Hope I am clear with you. Now let us see how the portfolio performance evaluation have to be done and why. First, how well did the portfolio do? In the sense, if you expect, example, 5% return, but the portfolio is giving only 2%, definitely the diversification is required here. You need to diversify the portfolio. If at all you find any asset which is giving profit of more than 5%, then you can diversify it. No, if you did not find any asset, then what you have to do, either you increase the fund in this, or else you can withdraw and invest in the other alternative which is giving little more better than, that is more than 2% and less than 5% you can assume. So how well did the portfolio do have to be considered, then you have to take a decision. Now how do we adjust for risk to compare different managers? If at all it is a fund manager, definitely you have to compare the different fund managers, or else different funds. Funds means, especially this word we use it in a mutual fund. Okay, so if you consider this is in a general term, then you have to say that what is the risk you are taking towards this fund. Okay, what is a fund? See, for example, if you want to get 5% return, then you need to bear 5% risk. If you want 5% return, then if you want to bear, you have to bear 2% risk. Definitely what do? You would like to choose this kind of an investment. If the first one, whatever we have spoken about, it is related to this kind, then you can say that the portfolio is not working that well, right? Probably this may work well, right? So we have to understand how do we adjust for risk, whether you want to take a higher risk and higher return, because probably there may be a scope of getting 10% return on bearing the 5% of risk, right? So likewise, you need to understand before evaluating the performance, how do we adjust your risk so that you can diversify this particular fund into another asset. Now, why? Why to evaluate your portfolio? Why you want to understand the fund? Why you want to adjust your risk? Why you want to know whether the portfolio is working well or not? In the sense, first one is risk. Are you a risk appetite? Then fine. This is okay, because you are getting 5% risk, whereas in return you are expecting 10%. Then timing, is the maturity is within your stipulated time, that is 1 year or 5 years or whatever you have expected. Then whether the asset allocation is done properly, or do you need to change, or are there any changes in your expected and current. So that can be found only with the review process. Okay, then security selection. See, asset allocation is different and security selection is different. We are allocating in an asset, right? So if at all it is in a mutual fund, see for example mutual fund, which mutual fund you are going to invest in? Is it a debt mutual fund or equity mutual fund or tax saving fund, whatever it is. if you are selecting a security, means like shares, share market or stock market, then you are selecting IT sector or bank sector or FMCG sector or any other metal sector or whatever it is. So this is a security, right? Within again IT, we are going to select Wipro, we are select TCS, we may select any other like TechM and all those things, right? So these are what the securities, and this is the asset. This is also an asset. So that is how you need to check the performance of your investment. Then you can decide what to do with the existing performance and how it is going to work for you. Then you can make changes whatever the requirements you wanted to do for it, so that you can get higher return, right? So that's what right? Yes, that's what for today's friends. And this is what about the asset allocation. And any further video if you want on the asset allocation or portfolio performance, definitely it will be recorded and posted for you. Till then, take care. Bye bye.